Here's a scary statistic. Nearly half of Americans have no idea what type of retirement account they actually have, and almost a third have nothing saved at all. The good news, retirement accounts are not complicated once someone actually explains them clearly. That's exactly what we're doing today. 5 minutes. Every major retirement account, the pros, the cons, and which one fits you. First up, the traditional 401k. This is the most common retirement account in America. Your employer offers it, you contribute a portion of your paycheck before taxes are taken out, and the money grows tax-deferred until you retire. The pros, your contributions reduce your taxable income right now, so you pay less in taxes today. Many employers match a percentage of what you put in. That's free money you should never leave on the table. In 2026, you can contribute up to $23,500 per year. The cons? You pay taxes when you withdraw the money in retirement. If you take money out before age 59 and a half, you get hit with a 10% penalty on top of income taxes. And at age 73, the government forces you to start taking withdrawals, whether you want to or not. Best for people who expect to be in a lower tax bracket in retirement than they are today. Next, the Roth 401k. Same contribution limits as the traditional 401k, up to $23,500 in 2026, but the key difference is when you get taxed. With a Roth 401k, you contribute after-tax dollars. That means no tax break today, but your money grows completely tax-free, and your withdrawals in retirement are 100% tax-free too. The pros? Tax-free retirement income is incredibly powerful. No forced withdrawals at 73 starting in 2024 for new contributions. Perfect if you think taxes will be higher in the future. The cons? No upfront tax deduction. Not all employers offer this option, and you still can't touch it penalty-free until 59 and a half. Best for younger workers who are currently in a low tax bracket and expect to earn more and pay more in taxes later in life. Now let's talk about IRAs, individual retirement accounts. These are accounts you open yourself, not through an employer. The traditional IRA works similarly to a traditional 401k. You contribute pre-tax dollars, the money grows tax-deferred, and you pay taxes when you withdraw in retirement. In 2026, the contribution limit is $7,000 per year, or $8,000 if you're 50 or older. The pros: anyone with earned income can open one. Easy to set up through any brokerage. Wide range of investment choices. The cons? Much lower contribution limits than a 401k. The tax deduction phases out if you earn above a certain income and already have a workplace retirement plan. Same 10% early withdrawal penalty applies. Best for people without access to a workplace retirement plan, or who want to save extra beyond their 401k. The Roth IRA is the fan favorite, and for good reason. Same $7,000 limit as the traditional IRA in 2026, but like the Roth 401k, you contribute after-tax money and everything grows completely tax-free. The pros? Tax-free withdrawals in retirement. You can withdraw your contributions, not the earnings, just what you put in, at any time without penalty. No required minimum withdrawals ever. More investment flexibility than most employer plans. The cons? Income limits apply. In 2026, if you earn above $161,000 as a single filer, or $240,000 as a married couple, you cannot contribute directly, and again, lower contribution limits than a 401k. Best for anyone who qualifies, especially younger or lower income earners who want maximum flexibility and tax-free retirement income. Last one, the SEP IRA. This one is built for self-employed people, freelancers, and small business owners. SEP stands for Simplified Employee Pension, and the numbers here are enormous. In 2026, you can contribute up to 25% of your net self-employment income, up to a maximum of $70,000 per year. That dwarfs every other account on this list. The pros: massive contribution limits, easy to set up. Contributions are tax deductible, perfect for high-earning self-employed individuals. The cons: only the employer, meaning you, can contribute. Employees of your business must receive the same percentage contribution you give yourself. Early withdrawal penalties still apply. And it's a traditional pre-tax account, so you'll pay taxes on withdrawals in retirement. Best for self-employed people and freelancers who want to save aggressively for retirement. So which account should you choose? Here's the simple answer. If your employer offers a 401k match, contribute enough to get the full match first. That's your number one move regardless of everything else. If you qualify for a Roth IRA, open one. The tax-free growth over decades is one of the most powerful tools in personal finance. If you're self-employed, a SEP IRA gives you the highest contribution limits of anything on this list, and if you can, use multiple accounts together. There is no rule that says you can only have one. Retirement accounts are not something to put off until you feel ready. The best time to start was yesterday. The second best time is today. Even small contributions made consistently over time turn into life-changing money, thanks to compound interest working silently in the background. If this helped you understand your options, subscribe for a new money lesson every single day. We make finance simple, so you can make smarter decisions starting right now.